Are you struggling to find sniper trade entries? The TDI, or the Traders Dynamic Index, is actually your secret weapon. Now, most traders actually get trapped in fake moves, but with the TDI, you will know exactly when to enter and when to stay out. So in this video, I'll be taking some time to show you step by step how to use the TDI for sniper trade entries. First off, we would want to understand what is the TDI and why is it important, especially when you're trading the BTMM strategy. The TDI is an all-in-one indicator that actually combines multiple trading tools into one single trading system. All right. So it helps traders to confirm trend direction, momentum, and volatility in the market. For you to properly understand how the TDI works, one of the things that you must pay attention to or be able to understand is its key components. Number one, a TDI has something we call levels. So when you install your TDI, usually it comes with these levels here. So here we have level 63 and 67. Then we have level 50, and we have level 37 and 32. So level 63 and 67 is our overbought area, all right? And when the market is trading in the overbought area, we are looking for a bearish reversal. We are looking for the market to go short. Then we have level 37 and 32 area, and this is what we call the oversold condition, all right? Oversold condition. So when the market is trading here, we are actually anticipating or looking for a bullish reversal. Then we have the level 50, and this is what we call the neutral line. When the market is trading here, we say it's neutral, all right? We don't have strong buyers or strong sellers. So we wait until the market decides what direction it's going to take. So that is all about levels. So like I said, when the market is trading in the oversold, we are looking for a bullish reversal. And when it's trading in the overbought, we are looking for a bearish reversal. Now that is key to understand. Let's look at the other feature. The next component is what we call the volatility bands. And the volatility bands are actually the blue lines that you see on the TDI, right? These blue lines, all right? Now, these blue lines, we call them volatility bands, and they are derived from the Bollinger Bands, right? And what happens is that these two bands will show us when there is volatility in the market and when there is low volume. So when the market is trending, nicely, the bands are usually wide open, right? The bands are usually wide open. And when the market is not moving, it's just consolidating, then the bands is usually squeezed together, right? But when we have the bands wide open out, then we say the market is trending. Now, they are also going to help us identify traps in the market. Okay, now we're going to come to that. So for now, understand that these two lines will help us know when there's volume and volatility in the market. And when these bands are wide open, we are looking for big moves. But when they are squeezed, we want to stay out of the market. When they are squeezed like here, we want to stay out. When the market or when the bands are wide open is when we are looking to take a trade. Okay, on to the next one. The next feature is what we call the price line or the green line on the TDI, right? It's the RSI price line. Now, this is actually your trade trigger. Now, generally, what this price line is doing is showing you the current price sentiment. It's telling you what is currently happening in the market. If you look at the price line and the way the market is moving is almost exactly the same. Whenever the market is going down, the price line is also going down. Whenever the market is going up, the price line is going up. So this is going to guide you when you should execute your trade or stay out or also exit. Something that you need to understand is that the price line is your trade trigger. But most importantly, you need to know when it tells you to enter a trade. So for instance, when the price line cuts the band, right, going out, it means the volume is high. But when it cuts going back in, it means the volume is reducing. And it means that once it cuts out and then cuts back in, this is what we call a shark fin, all right, or a TDI shark fin. When the TDI cuts outside the band and then cuts back in, we get a shark fin. Whenever it cuts out and then comes back into the band, we get a shark fin. Now, consider the TDI as a lie detector. Why am I saying so? It means that everything that is happening in the market must be contained in within the bands. All right? It must be contained in within the bands. And so, whenever the price line gets outside the band, it must always come back in. So we can say the bands is a center of gravity. It is pulling things, or it's pulling price towards the middle. So whenever it's going out towards the outside, it must always come down. And whenever it goes outside towards the downside, it must always come back up. So meaning that the volatility is pulling things towards the central point, meaning that price must always be trading in within the bands. All right. So we've said when the price line goes out and comes back in, we get a shark fin. But also you need to know that when the price line gets outside the band, we say that that is a trade setup that is in play. So when the market goes out and then cuts back in, it tells you you should prepare to sell. So now you wait for a trade confirmation. Now, for a trade confirmation here, you can see we have a shark fin, meaning that we are looking for a sell. So let's assume this was Asian session right here, and we already had a shark fin. So we know the market is going to sell. So after the Asian market, we are looking for a sell opportunity. You can see the market pushed up once, twice, three times. Then we have our M formation. But look what is happening at the TDI. The TDI is not recognizing this entire move. So we have what we call a divergence. And once the RSI price line cuts back in, you get your trade confirmation. So among many other confirmation that you'll be looking for, here we can say you have a confirmation to execute your trade, right? So this is a shark fin. All right. And when the TDI does not recognize this move, we say that it is creating what we call a divergence. However, we'll come back to that. All right. So let's look at something else. The TDI also has something we call the signal line. Okay. The signal line. Now, the signal line is actually your trade confirmation. It tells you when to execute the trade and when to exit that trade. So we are technically saying that when the green line and the red line cross, we have a trade. Whenever these two lines cross, we have a trade. All right. But again, you have to know what kind of a trade you have. It could either be a short-term trade, meaning a scalp opportunity, or it could be a long-term trade, meaning a reversal. All right. So now, for instance, when we have the green line here cutting with the signal line, we have a trade confirmation. And you can see here, we got a short-term buy or a correction. Then it cuts again going down. We again get a sell trade. The market goes down. Then the price line cuts going up. We get another buy opportunity. You can see it here. The market pushes up. Then it cuts again going down. And we have this whole move until it cuts again going back up. And so you exit your trade. So technically we are saying whenever the green line and the red line cross, you have a trade. So here, as I was saying earlier, you could have taken this trade right here, okay, right after the Asian market is closed and London session kicks in. So here you see the green line crossing with the red line, meaning that you have a confirmation to execute your sell trade. But now there's something I want you to note. You're getting a sell opportunity, but these particular indicators are trading at the overbought conditions. So it means that you have a strong confirmation that this market is actually going to sell. And so you could have booked some good gains before you again get a signal to exit that trade right here and the market took off. The other feature is what we call the yellow line or the market baseline. Okay, there's one right here, the market baseline. So usually we say this market baseline is your trend identifier. It tells you what is generally happening in the market. Okay, so when the green line and the red line are trading above yellow EMA, we say the market is bullish. And when the yellow line is trading or is pointing up, we say the market is bullish. So from here, we can say the market is bullish. Okay, the market is bullish. And when it's pointing down, we say the market is bearish. And if the two lines, the signal line and the price line are trading below it, we say the market is bearish. However, when the market baseline is trading at the bottom or the top, meaning the overbought or the oversold, again, it signifies that we are looking for a long-term reversal. Remember, this is the long-term trend identifier. It tells you what is generally happening on the higher time frame. So when the yellow EMA is actually trading at the bottom of the TDI, it means you're looking for a reversal, a long-term reversal, because the higher time frame is actually saying we are oversold, or maybe we are overbought, just in case it was in the opposite direction. So here we can see the market baseline was in the oversold areas, and we can see the TDI price line and the signal line could not recognize this entire move towards the downside. You can see what is happening here. So we get a shark fin, and this entire move is swallowed into the TDI. So meaning once we got this double bottom here, it was a clear confirmation the market is going to the upside. And then, of course, with this cross here, where the green line and the red line cross the yellow line, means again, you get another confirmation that the trend has now changed to the upside. So now we are looking at these indicators differently depending on how they are behaving and where they are trading at. So if they were trading in the middle, if they were trading here, we would say we don't have a clear bias. We don't know what is going to happen. The market can either go down or it can go up. But when they're trading at the oversold, it means you're looking for a bullish reversal. And when they're trading at the overbought, you're looking for a bearish reversal. Especially when the yellow EMA is trading either in the oversold or the overbought, it means that a reversal is imminent. Start looking for a reversal setup. Okay, let's continue. So I hope you understand what is happening here. But technically, I have first of all been able to cover some of the key components of the TDI, and I hope you've been able to understand or get something. So understanding these components will actually help you trade with confidence and avoid fake outs. You'll avoid those wrong trades or early entries, right? I don't know how many times you've entered a trade. You know the setup is for sure saying this is a buy setup. The market should go up. But once you execute that trade, the market comes and hits your stop loss. Then it goes your direction almost 50 and 100 pips. It means you took your trade too early. And the TDI is going to help you filter or tell you to wait or to execute your trade or to also exit your trade with the maximum profit. So far, so good. Let's look at something else. So how do we use the TDI for sniper entries and exits? That's the biggest question in the house today. How do we use the TDI for sniper entries and exits? So number one, there are several ways you can actually use the TDI, but I'm going to talk about 3 ways you can use the TDI to actually get those sniper trade entries and exits as well. So number one, you can use what we call TDI crossovers, and this is actually your most important signal on the TDI crossovers. Now, do you remember when we talked about the green line crossing above and below the red line? That is going to be your signal. So for a buy setup, you want the green line to cross above the red line. And that means we get a bullish crossover. So when they are both below the yellow line, meaning that they are both below the yellow market baseline, it means that that is a strong buy signal because it's probably a reversal. Okay, it doesn't mean that it's going to happen all the time, but it's going to be probably a reversal. Okay, then for sell setup, you want the green line to cross below the red line, and that means we get a bearish crossover. We get a bearish crossover. So when they are both above the yellow market baseline, it means it's a strong sell signal. It means it's a strong sell signal. So we are going to come to examples. For instance, let's look at this one here. So from the look of things, here we have several crosses. So here we can say when the green line crossed above, we got a buy opportunity or an exit for a sell trade. So we can say if you're holding a sell from here, okay, a sell from there, the market went down. And once they crossed back here, then that would have been your exit. Then well, the moment they cross going down again, you get a sell opportunity. And then once they cut going up, you get a buy opportunity. Here you can see right at the high, we get across, and this is even as strong because the TDI had already created a shark fin, meaning that this particular trade here was a very strong signal. So once they cross, you get a sell opportunity and the market goes all the way down. Once they cut again, going to the opposite direction, it means you exit that trade and you go to the opposite direction. So here you could have exited that trade right there and you go long, and then you're going to stay in the trade and until here when they cross again. And then once they cross going back up, you get another entry and you would stay in that trade until the price line cuts again going back down, which was right here, right at the high. Okay. Now look at this. Before we get this move down, okay, we get a nice M formation, but this M formation head is actually speaking volume. So we can see here we have equal highs, only that at the TDI, we have a huge divergence. This second leg is being formed while the price line is already saying we are already selling. So this one would have been a very strong sell opportunity. And if you executed this sell right here, then you are able to bag in some good gains. So you could have taken a sell right here. This one would have been an exit, another entry here, and so on and so forth. So those are crosses, okay? Those are TDI crosses. I hope you understand up to that point. Let's look at something else. Number two, you can use what we call TDI bounces or the TDI bounce strategy. So in this case, instead of looking for crossings or crossovers, then we are only looking at the green line to bounce off the red line or also to bounce off the yellow line or the EMA. I'm going to show you how. So this is actually going to confirm your trend continuation, and it is usually ideal for re-entries. It is usually ideal for re-entries, especially when you're scalping. The market is going up or it's going down, and so you want to ensure you maximize the potential of that move. So the TDI bounces is going to help you confirm your trade continuation setup. So let's look at examples here. Okay, so from the look of things here, we can see this is gold. Okay, this is gold. So here we get a cross, meaning the market is now going up. Okay, so every time the market pulls back to the signal line, we get a trade entry. So this one here is a trade entry. Then again, right here, you get another trade entry. The market pushes up. Then here, the market is going down. We get a bounce from here. You get a sell. You get another bounce here, and you get a sell. In this case, we are going to consider this upward move here. We get a bounce here, we get a bounce here, we get a bounce here. So all those are entries when the market is actually trending either upward or downward, meaning that you can actually trade TDI bounces. The moment you have established a setup, probably is a bullish setup like this one, now you want to look for entries. Always wait for the price line to tap the signal line and then bounce. Once it bounces, you take your trade. It touches again and bounces, you take your trade. Touches again and bounces, take your trade until they cross. Once they cross, you know that that move is actually done. And now we are going to the opposite direction. And that's how you trade the TDI bounces. Now, that's not everything. Let's look at something else. Finally, you can trade what we call TDI divergences, or you can use TDI divergence strategy. Okay, so this is a scenario where the price makes new highs or new lows, but the TDI doesn't. Okay, so if the price makes a new high, but the TDI doesn't, we say we are expecting a bearish reversal. Okay, this is what I mean. So let's suppose the market is going up, going up, going up. So then we can see here the market has created a new high, But then at the TDI, this is what we are going to get. The market TDI makes a new high, and then it starts going down. So it's going down here. Only that at the chart, the market is going up. So this is what we are going to call a divergence. It means that the price is actually overbought, and so a reversal is imminent. A reversal is imminent. The TDI is already telling you this move here is fake. All right. And so the market will have to sell off. Okay. Or the market can be going down. All right. For instance, we can have lower low, market goes up, creates a lower low, goes up, creates a lower low, creates a lower low. But then at the TDI, this is what we have. Okay. I'm assuming this is my TDI here. So we have a lower low, a lower low, a lower low, and then the TDI starts doing this. It starts going up. So clearly we can see here the market is going down, only that at the TDI, we have the market going up. So this means we have a divergence. And this means that a reversal to the upside is actually imminent or is to be expected. So once you have a setup, maybe something like a double bottom, or maybe something like a triple bottom, or maybe something like a head and shoulder, then you are going to use this as your trade confirmation for a reversal to the upside. So these are divergences. Now, we have two types of divergences. All right, we have two types of divergences. So I'll briefly talk about them just so that you're able to understand. So we have what we call a regular divergence, and then we have a hidden divergence. So for a regular divergence, we have the market going down, making lower lows, but then at the TDI, we have a lower low, then at some point, it starts creating highs. Now, this is what we are going to call a regular divergence. It's clearly visible to your eyes. Okay, it's clearly visible to your eyes. All right, or we can have the market creating higher highs, higher highs, higher highs. Then at the TDI, we have something like that. Okay, then it starts going down. So meaning that this is again a regular divergence. So we are looking for a setup like maybe a double top or maybe a triple top, and then we get a confirmation to go short. So this is a regular divergence. But then we have hidden divergences. We have hidden divergences. Now for hidden divergence, what happens is the market could make something like this. Okay, we could make something like a double bottom, or maybe even a shortened second leg. And then when you look at what is happening at the TDI, you realize the first leg is created like that, and the second leg is created like that, right? Meaning that even though at the chart, this leg here is short or it's equal to the first leg, at the TDI, it shows that it is actually extended. Now, what generally this means is that this here is a stop hunt. It means this is a liquidity grab. And so you are now looking for a reversal to the upside. Now, in the opposite case, we could have equal highs, okay, something like that. And then at the TDI, we have something like this, okay? This here is a liquidity grab, meaning that the market has already used this as a liquidity grab. And so we are looking for a reversal to the downside. It could also appear like this. It could appear like this. But then at the TDI, even though at the chart it looks like this, at the TDI it looks like this. So again, we say this is a liquidity grab. So we are looking for the market go down. So we have two types. We have the regular one, and then we have the hidden. Hidden means it's not going to be, you're not going to necessarily see it, all right, unless you've really mastered how to use the TDI. So far, so good. So let's look at something else, or rather some examples of how to use TDI divergence, okay? So here we have an image of pound yen, and I want you to be really keen on what I'm going to do here, right? So from the look of things, we can see the price here was making lower lows, right? The price was making lower lows. Only that at the TDI, we are getting a higher high. So this one here was your setup or was your entry to catch this move to the downside. Okay, so because you can see we have a clear divergence of price on the chart and on the TDI. So the second leg, even though at the chart was lower than the first leg, on the TDI, the second leg was higher, meaning that we were expecting that bounce to happen to the upside. Now, let's look at another example here. So we have these particular moves here where the price pushes down, bounces back up, comes all the way down, and extends below this low. But when you look at the TDI, what does it tell you? That this here is not a true move. And so a reversal to the upside was to be expected. So immediately the green line crosses the signal line. We get a buy signal here, becomes your entry, stop loss goes below right there. And we get a nice push the entire end of New York session before the market closes. All right, now we have something else here. So from the look of things, we can see here, this is the low of the day, London session, and we get a nice sharp fin and the market starts going up. The New York session, the same low is repeated again, only that even though the market breaks below the London low, at the TDI, we do not recognize that move. That again, we say is your confirmation. So you take your trade long, and then you can see the market was able to push up and never broke that low again. So that is one of ways to use divergences. Let's look at another example. So here again, I have pound yen, I believe so, but I want you to look at some of the things that the market does to play with your mind. So from the look of things here, we have the market saying that we are going up, creates a high, creates another high, creates another high. So the market is generally going up. But at the TDI, what we have? A divergence. It says this is a high, but all these higher highs are not recognized by the TDI. And so once we get a nice setup, a double bottom, okay, and then across on the TDI, then we say this is a very strong signal for a sell or a drop, right? And you can see the market spilled all the way down. Now, equally, we can see here the market is making lower lows, or we can count 3 days of drop: day one, day two, day three, and then day four is when we get these pin bars to the bottom. But at the TDI, even though these are low, the TDI is saying no. We had a shark fin. This was the first leg. And then this here is your second leg, right? But you can see it is extended way below these lows, right? But at the TDI, it is telling you no, we are actually going up. So this one here was a very nice confirmation for a buy trade, and you can see the price pushed higher. So now, what are we trying to say? What you're saying is divergences are going to help you identify reversal signals. Majorly, they are going to help you identify reversal signals, or they're going to help you identify perfect entries just before the price moves. All right, let's look at another example. Here we can see that the price is actually making almost equal lows, right? These lows are equal, or they are tapping the same level. But at the TDI, we have this as our first leg, and then this is our second leg, which is way higher than the first leg. So now this is, in other words, what I'm calling a hidden divergence. So we can see the TDI is saying we are going up. Only here we are at equal lows, right? We are at equal lows. And then let's look at something else here. So you can see here the market is saying we are going up, but the TDI says we are going down. So we have a shark fin and a second leg, which is inside the band and across of the price line and the signal line. This becomes your entry. And so once Asian session is closed, it becomes your entry to go short and the market goes down. All right. So when you combine these TDI strategies with the BTMM strategy, you can avoid the market maker traps and trade with precision. So now let's jump into the charts and see the TDI in action. And so let's look at what is happening here. Okay. So from the look of things, this day, the market issued a first leg, and then we go into consolidation, Asian range. We get the second leg issued the following day, London session. And so this becomes our multi-intraday, multi-session double bottom. But then when you look at what is happening, here we get the market going up, only that at the TDI, we have equal lows. Okay, we have equal lows. Now, this is what again we call hidden divergence. And so once we get this cross, it becomes your trade entry, or it becomes your confirmation to go long. Now, on this move, we took a Euro USD trade. And so let's look at it and see how it played out. So I remember here we had Euro going down, all right? And we had a very impulsive move to the downside, okay? And so I know it was as almost impossible for someone to think that the price of euro at this point would reverse to the upside. But when I was looking at the TDI, there's something I noted, right? So from the look of things, this day we have a nice double bottom with an impulsive move issued during New York session. The following day, I wanted the market to revisit this level, and it is what it did. But now, for me to get my precise entry, okay, I went to the 5 minutes. I know this is my level. Okay, so I'm looking for the market to come back here, give me the second leg, and that is exactly what they did. So when you go to 5 minutes, I want to show you something. When you go to 5 minutes, you're going to realize we have a very nice double bottom. Okay, we have a very nice double bottom. So the market issues the first leg, goes up, comes down with that red candle, and then we get a big bullish candle. That is my double bottom right there. So why am I saying it was a very strong signal? So look at what we got. We get a shark fin issued the first leg, and the second leg, even though it was this extended, it was inside the band. And so the TDI did not recognize this move. So once we get across and a confirmation here, this becomes now my entry. So I took this trade right here, and we were able to exit with about 45 pips all the way to the end of London session. So again, New York session came in. So this was our current high of this day, London session. When New York session opened, they revisited the same level, giving us a nice doubled double top right there. So why am I saying that? You can see at the TDI, we have a shark fin and the price line gets back into the band and it is trading inside the band. Then we have a cross and a divergence. So if you look at what is happening here, the market is saying we do not have the momentum that is being created on the chart to the upside. So the market is going to sell. And so I remember taking a short here for some 20 pips to the downside before New York session closed. So generally, that's how we are using divergences. So let's look at now maybe something like a cross. Okay. And a cross happens almost every now and then. Okay. So for instance, here we have a cross, actually two of them. Okay. So we have the first one here where you could have decided to take a buy here. And we have this one here where you could have decided to take this buy right here. So why wouldn't you have taken a buy right here? Because at the first leg, you always want to expect a stop hunt. And these are the three bars you're seeing here. Do you remember, maybe if you have watched Steve Mauro's videos, and he's always insisting on these three bars, stop hunts, right? So the market issues these three bars to the downside before we get our confirmation to go long right here. And so you could have taken this trade for some good 20, 30 pips. All right. Now, the same level was repeated towards the close of New York session. Only that if you look at what the TDI was saying, no, we are not low. The market is going up. So you could have still taken this trade right at the bottom right there, and you could have again secured another 20, 30 pips before the market closed. So that is a TDI cross, right? So you're looking at the scenarios where the price line crosses the red line going up, the price line crosses the red line going up, or the price line crosses the red line going down, and you get a trade. So you must know how to combine the TDI with other indicators or maybe price action for you to be sure that what you are actually seeing is the right thing. So I'm only showing you examples, but it takes a lot of practice. It's not something that you're going to just watch one video and assume that you now know what is happening in the market. So look at this one right here. Now we can see the market is generally going down, but look what the TDI is saying, right? Look at what the TDI is saying. So here we get a trade confirmation to go long because even though the market was going down, TDI was almost flat. TDI was almost flat. So we get a stop hunt. And once they confirm going up, or once the price line crosses the red line going up, we get a trade confirmation to go long right here. And this was a very nice trade towards the high of the day. Okay, let's look at something else. So here is another divergence. Okay, so here you can see the price is clearly showing you a lower low. This is the low of New York session, but then at the TDI, you can see what is happening. Clearly, the TDI is saying we are not falling for this entire move. The market is still bullish. So once you get a confirmation to go long right below here, and the TDI we have across, then you execute your trade without fear with your stops below the particular market structure. And this was a very nice impulsive move before the market actually closed. So those are just some of the ways of using the TDI. I said I'll only talk about three, but then there are several other ways of using the TDI, and you need to first of all practice the simple ones. What I have given you are the simplest and the easiest and the most profitable. But then once you start mastering the TDI, you realize that you can actually get to use it for several other uses, and you can combine it with several other strategies. Now, in my case here, and the next indicator we're going to be talking about, which is the work time, which is now the sessions you're seeing printed on my chart right here, and how you can actually get to combine the work time and the TDI to become an independent strategy, right? Where you utilize the session liquidity, the session highs and the session lows to trade using these particular indicators. And you're able to be very accurate. You're able to get some very nice trades. So if you don't want to miss out on that video, then I will request you to actually subscribe and hit that notification button so that once I upload it, you will be notified. Okay, so now that you understand how to use the TDI, the next step is now to combine it with the BTMM indicators for sniper trade setups. I've been talking about several indicators. I believe if you've gone through some previous videos, I've talked about several indicators. This is not the end. We still have about 3 or more to cover, including the daily high-low, the work time indicator. We also have some few other bits that I just to polish up the strategy and so that you're able to know how to effectively utilize the strategy. So we'll break down how to use the TDI, the ADR, the EMAs, and psychological levels all together to find those perfect entries. So make sure you don't miss it. Hit that subscribe button and turn on that notification bell right now. Anyway, thank you so much for watching this video. Really appreciate your time, and I hope to see you in the next one. Peace out.